Hi, and welcome to our next session of Venture and Capital interviews. Today I have with me Craig West, who's the founder of Succession Plus. Welcome, Craig.
Hi, thanks for having me.
Now, I've actually known you, as I mentioned, I've known you for some time. And look, this area of succession is interesting. I remember at the time, I think it was probably about 8 years ago, maybe even 10 years ago. But I remember you put up some stats, and it was specific around how many businesses are going to go through that succession process. So if we're going to start from an area, that's probably the best area for me to go from, and also a bit about your background and why this is such a key area for you.
Yeah, sure. I mean, in terms of the stats, the raw stats are pretty amazing. At the moment, there are more than 5,000 people a week turning 65 in Australia. So if you think about that in terms of the people that own businesses, there are large numbers of people approaching retirement age. Now, 65 is not the retirement age that it used to be, where everybody retires on that date. But there's a lot of people, aging baby boomers that own businesses, that are heading towards some kind of transfer of ownership, whether that's a sale, a listing, passing it on to their kids, management buyout, doesn't matter. All of those people are gradually going to transition ownership of their business. So, and for me, the real focus in that area is that represents a hell of a lot of wealth. There's a lot of money tied up in privately owned family type businesses in Australia. And so making sure that that wealth gets managed properly in terms of the transfer is actually quite important, because it's not like, I sell shares in Westpac Bank and you buy them while the wealth transfers from me to you. But in privately held businesses, the wealth actually disappears if it's not managed properly. Money just literally evaporates. And that's not an outcome anyone wants.
Because I think the sad reality for a lot of founders is that often their kids don't want to take over the family business. So then what happens then?
Yeah, look, that trend has been happening now for about 20 years. It used to be the case, go back 40, 50 years to our parents' generation. If you had a family business, your kids took over. It was automatic. There was no discussion. It's just what happened. It's a farming type history and background. Our rural communities and so on still do that. And kids take over mum and dad's farm. But in other businesses, that's not necessarily the case. Kids are doing all sorts of different things, and so they don't want to take on the family business, which means you need to look at other exit options. If you're not going to be able to pass it on to family members, and you're right, that's not so common anymore, then there needs to be other options. So are you going to sell the business externally? Have you got key staff that want to buy it? Is it big enough to list it? And there's a whole stack of other options as well, private equity firms, venture capital, etc.
Yeah. And I'm sure this is years in the making where they come to the conclusion for this type of decision. And
correct.
Like when do you find they typically start thinking about this process?
Generally too late, unfortunately. The problem is
let me guess. Typically it's a health incident that triggers it, and then they start thinking that, okay.
That's right. There's two things that really do happen. The problem is if you're passing a business on to your family, you don't actually need to do a lot of preparation. You just pass it on to the kids. They've probably worked in it for years anyway, so it's not a difficult transaction. But if that option's no longer available, all of the other options require a lot of preparation and a lot of work. And so you have to start as early as you possible. I tell people all the time, Steve Covey's second habit is begin with the end in mind. Know where you're going and what your exit option looks like, because then you can prepare best for it. And those people that prepare for a reasonable amount of time generally get the best outcome. You're absolutely right, though. What generally happens is either a health incident to the owner or their immediate family, or hopefully they might see a friend or a partner or someone they've worked with before selling their business successfully, making really good money on it, and that actually triggers them to take some action. But the earlier you start, the better.
Yeah. And what do you and how you work with companies? What have you seen, let's say, some of the more successful things that sort of companies have done to set themselves up to go to, are they setting themselves up 3 years, 5 years? Who are they involving in the process? How are they communicating? What are some of the successful habits that you're seeing?
Yeah. By far the best results are 3 to 5 years out. So if you start 3 to 5 years before you actually want to exit, then you're in a much better spot. My view is every company should have an exit strategy anyway. Even if you're 25 years old, you should have an exit strategy.
And I have to say, for the 25-year-olds, because we do have young audience that sort of sometimes 5 years is not it feels like a long time when you're 25, but I can show you when you launch a business, 5 years can disappear. 3 to 5 years can disappear like that. And often
Absolutely.
it's the stage where you're so busy doing stuff that, and anyway, it's just, I also agree that a company should always start with that sort of end in mind, even though we often don't talk about it.
And a lot of what you're seeing in the market now is businesses that are always exit ready or sale ready, sell for better prices. There's a lot of unsolicited offers at the moment. So it's not just people preparing their business for sale. It's when somebody knocks on your door one day and says, hey, I'd like to buy your business. And you suddenly think, oh my God, I haven't got anything ready. I've got no documents. My accounts are a mess. I haven't got any, you're never going to sell it at that price, at that place.
And where do these unsolicited offers typically come from?
You look at the moment, I mean, there's a lot of very cashed up corporates, listed companies, private equity firms are sitting on large amounts of cash. So if a private equity firm has gone into a particular industry, let's say they've gone and bought a firm of architects, well, the next thing they want to do is add what's called bolt-ons. So they want to go and find other architect firms or people that are in related industries, surveyors, any civil engineers, anyone that's in that related sort of area, and maybe geographically. So they bought a firm in Melbourne, now they want to buy one in Sydney and Brisbane. So that's where these unsolicited offers come from. People sort of start to look around and see what they might be able to buy. And
from your experience, Craig, do PE groups tend to like to deal with the owners directly, or do they typically like the companies to have let's call it a corporate advisor or someone in between? What do they prefer?
Generally, they prefer to have an advisor because, let's face it, most people that are in business today are not experts at mergers and acquisitions. They're experts, in my example, they're architects. So they're not going to necessarily be very good at mergers and acquisitions. And often most of them don't know the valuation of their company. They don't know what makes it valuable to other people. So having an advisor in place, these are professional buyers we're talking about. Private equity firms do this all day long. So they know what they're doing. Mum and dad don't. Therefore, having an advisor in there can often smooth the process and make it a little bit easier to cope with, because it's a difficult process. People are selling their entire business. There's a lot of work, a lot of legal implications.
There's a lot of emotion involved.
Absolutely. For a lot of people, particularly when we were talking about baby boomers before, some of these people have owned and run this business for 30, 40, even 50 years. It's their baby. And so having someone come in and poke and prod around it and look at all the documents and so on, it's quite a confrontational outcome if you don't handle it properly.
And when companies are going through that process, let's say they get an unsolicited offer, they're going through the process, whether it be a corporate or a PE group or whatever, how do they manage that process, and how do they tell the staff? Do they not tell the staff? Like, how do they sort of work with the existing sort of staff members sort of going through that process, or do they not?
And that's a really good area where you need advice, because most people's instinct is not to tell the staff anything. The reality is, and what the research tells us is, employees generally know what's happening anyway. It's pretty easy to find out. Most buyers will start to do things like they'll get on LinkedIn and look at every single employee's profile to see who works there and how long have they been there and what skills and experience do they have. Well, that suddenly raises red flags. And so it's very hard to keep these things confidential from staff for a long period of time, maybe in the very early stages.
Yeah.
But what I find is people that are open and honest with their staff and have the conversation will generally get a better outcome. Often the key thing for most buyers as well is the key people in the business. So How are you going to lock those key people in? If I go and buy your business tomorrow and half your staff leave, I've got a very big problem. I've just spent a lot of money on a shell. So having a strategy in place, which might be a stay bonus or an employee share plan, for example, to lock those people in, can add significant value for the sale. But you also have to communicate that and talk to them about what you're trying to do. Most business owners think their employees will be very negative and worried about that. In fact, the reverse is true. Most employees see it as an opportunity for, sure, there'll be some change and, there might be a little bit of different ways of operating and different things going on, but there's always an opportunity because now we're being bought by a bigger firm. I've probably got more opportunity in terms of career and development. And so employees generally see it as a positive thing, but they hate being kept in the dark and lied to. So my advice would always be to talk to your employees, but have a structure, either an employee share plan or some sort of incentive plan, a stay bonus, to make sure the employees are locked in.
And let's say on the investor side now, so let's say obviously we talk to investors as well. If I'm an investor and I'm thinking about how I can sort of take advantage of this as an opportunity, what sectors am I looking at? What are the type of businesses that should be appealing to me? What have been the ones that you've seen that have most successfully transitioned from being the sort of owner operator into a sort of managed investment business?
Yeah, and that last point you made then is probably the most important. Any business in any industry, and I'll go through some of the industries that are going really well at the moment, but any business in any industry, the biggest problem for privately held companies is they're dependent on the founder or the owner or the CEO, and you can't take that person out. Now, from a buyer's point of view,
they'll typically have a lock-in period if they're acquiring. They'll typically have a 2 to 3 year lock-in period, right?
Often they do, but the most successful sales that we've worked on with clients is where the owner can actually extract themselves. They become the chairman of the board. They might go into the office one day a week. They run board meetings. They've got a really competent management team that they've handed over management control. They've succeeded out of the business. They've got reports and responsibilities in place so they can manage what's going on, which means when the buyer comes in, that's not such a big threat then, that the key person's no longer there. But you've got to lock those people in, and that's where we're seeing a massive increase in things like employee share plans as a result.
And look, let's go back to that. So what you just described just then, that starts out with a habit, and often that habit can be started 3 to 5 years out. So you're spot on in that, what are the reporting lines? What is the organizational structure? Building that sort of management team that can drive the business forward that isn't reliant on the founder. That doesn't happen in 2 months.
It takes time, but if you think about it, we're talking about it from an exit perspective, but that's just good business sense anyway. Having a team of management in your business that are locked in, rewarded, but also that are, that have some accountability and reporting and roles and responsibilities are clear, that just makes it a nice business to run. So whether you're exiting or not, you should have that anyway. And in fact, a lot of the things that we do in preparation for exit are just good business sense anyway. So, there's a lot of preparation. Coming back to industries, you talked about industries. If you look at what's happening at the moment in the economy, there are several industries that are doing really, really well. Look, for example, at local tourism. A year ago, everyone in Australia was getting ready to go to Europe or the USA or Hawaii or wherever they went. No one's doing that at the moment. They're all here. So caravan parks, local.
Glamping.
Glamping, anything like that is going to go really, really well. And so I think you need to look at the economy. The other part of the economy that's going really well, and we're about to see a budget in the middle of a pandemic, you've already seen massive increases in infrastructure spending. So anyone that's involved in civil engineering, architecture, surveying, the built environment is going really, really well at the moment because government's spending a lot of money in those particular sectors. Online shopping is another one at the moment. People are doing a lot more online shopping than they ever have. So there's some sectors that you can sort of look at what's happening generally in the economy and see where those trends are. And then you need to find the businesses in those areas that are doing particularly well.
And I was going to say, look, also noting the nature of some of our investors as well is that often they sort of learned the skill of buying low and selling high, right? So you just highlight the ones that are doing well. There's obviously there'll be sectors where I know there'll be investors quite interested in areas related to, could be travel, could be entertainment, hospitality, and so forth. What are you seeing in those sectors? Are investors starting to say, look, let us know? Because at some stage there is the expectation that these businesses come back. This could be a good time for a transition period, etc.
Yeah, and particularly where those businesses are owned by baby boomers that are in their 60s or even 70s. And, they're looking at this saying, well, there's a hell of a lot of work to come back out of this now. And you know what? I'm 65. I've had enough. I've got enough money. Interestingly, in Australia, most business owners that are baby boomers are actually reasonably well off in terms of wealth outside the business. And so hopefully they don't need, the business sale to actually fund their retirement. They're fairly well off. They want someone to look after the business though. So there are lots of opportunities and there are lots of buyers out there now that are very opportunistic, as there always has been. And they're looking at some of those sectors like hospitality and events and entertainment where they've had a really rough time of it. Is there an opportunity to, as you said, buy low, grow the business coming out of the recovery? And, there's buyers out there all the time looking at things like that.
Now, two other questions. They're sort of opposite to each other. So I want to ask the first one around the emotions of an exit process. The second one around the structure of an exit process. So first one, the emotional side. What are some of the, let's say, negative characteristics you've seen founders go, or, business owners go through, and what are some of the positive aspects, just to give them some sort of contrast and to help anyone who's listening and thinking sort of set up, understand what's natural for them to be going through and what's irrational.
Yeah, look, there's a lot of research. There's actually a fair bit of research out of the United States around a model called role identity fusion, which talks about business owners and their business being inseparable. And in fact, the research, one of the conclusions in the research when I read it was quite horrifying. You sort of read it and think, oh my God. And the research says that for most business owners that have been in business for, 20, 30, 40 years, this is an event as significant as divorce or death of a family member. Now that sounds, you go, oh, well, okay, fair enough. But when you think about that, that's quite traumatic. So separating the owner from their business is quite a traumatic thing. And we actually spend a lot of time making sure not just the business is ready and the finances are ready, but the owner themselves. What are they going to do after they exit? Yeah,
that makes so much sense, because humans are habitual by nature, right? So that individual has got themselves a 20 to 30 year routine on how they operate life. And you're saying that you're going to wake up one day without that routine and have to think about what you do next.
And all that's gone. I had a great story. I sold a business a few years ago now, and I asked the owner, and we sold it for $20 million, right? So the guy's got plenty of money. What do you want to do? And his answer was, I want to play the top 10 golf courses in Australia. And I said, mate, that'll take you 3 weeks. Then what? Like, okay, go and play the top 10 golf courses. That's great. But then what? Like, you're 70 years old, you're fit and healthy. You might live for another 15, 20 years. What are you going to do? And most business owners, because of the way we work, entrepreneurs by nature, are 24/7 on the business. You take all that away, they suddenly wake up in the morning and go, oh, wow, what do I do now? It's 8 o'clock. I haven't got anything to do. I haven't got to answer any emails. I've got no meetings to go to. What do I do? And so that actual process, that emotional disconnection, is quite difficult for most business owners to cope with. And so one of the things that we see working well, and I mentioned employee share plans before, is this gradual, slow sell down. So instead of just saying, right, on the 1st of December, your business is sold and you're out of there, what we're seeing is, well, let's just start working 4 days a week and start selling some equity down to our 5 key employees or our 20 key employees. And then we'll get to 3 days a week, and then we get to 2, and then it's nowhere near as traumatic. It can actually take, that share plan model might take 5 or 10 years to implement, but it's a gradual exit for the owner. And importantly, it's a gradual entry for the employees as well. So it's not just suddenly tomorrow you're all in charge. Good luck, hope it works out. It's a gradual managed transition. That's actually becoming quite popular and working quite well in the right circumstance. Not for everybody, but in the right.
And it sounds like it also sets the right foundations for the business, and it's becoming less and less reliant on the owner as well.
I think in some ways it's the new family transition. We used to pass the business on to our children or our grandchildren, and they were sort of already in the business. They'd been working there, so it was a reasonably easy handover. Employee share plans are different, but they're the same, because the family is actually our employees. But we've now got a mechanism where we can gradually, in a very structured, organised way, pass that business over. And that comes back to the second part of your question was around process, right? So the employee share plan is a good example where what works really well for a win-win-win. You have to have a win-win scenario in these exits. So the business needs to be better off, the owners need to be better off, and the incoming buyer or employees need to be better off. So a gradual, structured process generally delivers that outcome far better than a sudden bang transaction. You're the owner today, I'm the owner tomorrow, see you later. Good luck, hope it all works out. Actually doesn't work out that well unless it's very carefully managed.
And to I suppose to re-emphasize this point, how important is it for the investors that they see that someone is actually well structured for this process? Because you've got to remember that the analogy I love to use is Blockbuster, right? And if you look at Blockbuster, everyone's got a positive memory of Blockbuster. Like I do events, I do workshops. I mentioned Blockbuster. You see people smiling, right? Because it was a family outing Friday, Saturday night, and that business went bust. Right now, what's really interesting is you think about markets will move towards efficiency. Investors will move towards efficiency. So the thing we try and educate is for most companies is how can you make it the most efficient process possible for a potential incoming investor. So, so for you, what are the key areas that you're looking at to help the companies to say, outside of the things that we've covered as far as the employee share option plan, like what information do you think that they should have available and ready? What are the types of structures that they can set up internally to make sure that this is efficient if they do have a potential investor coming in?
Yeah, there's probably 5 key areas that people really look at. Investors look at from a buyer's point of view, and owners need to have in place. Investors are happy to pay more money to get an asset that's less risky. So if you think about what makes a business risky, financials. So your finances need to be in order. Your accounting system needs to be up to speed. You need to have.
Now, what does in order mean? Have we got the last 3 years of financials? Are we talking audited financials or what?
Yeah, look, they generally look at a minimum of 3 years. Some people looking at 5 years. You don't necessarily have to be audited, but they need to be prepared and lodged properly by an accountant. People are looking now at payroll records to make sure you've been paying people the right rate, because there's a lot of people being caught out with that. Making sure your super and tax obligations are always up to date and on time. Making sure that your documentation is quite robust. So you've got credit terms with all of your customers. That you do credit checks before a new customer comes on board, so you're not getting caught with bad debts. So all those little process things around the financial operation of the business is quite important.
They're actually paid. They're actually annoying as well. For me, I recommend every founder, like your leasing agreements, your agreements with photocopiers, all that information suddenly becomes really important.
Absolutely. And that's where people go wrong, because it's a family owned business and I know what I'm doing and I've been doing it for 20 years. I don't need to worry about that. Things just get rolled over. Documentation doesn't get kept up to date. So we've got plenty of examples where we've seen clients that have got, lease agreements that have expired and they're now just month to month, which is fine until it's not fine. And then there's a big problem. So from a buyer's point of view, that's just high risk. So the financial operations is one thing. The second part is people. We spoke about employee share plans, but even the basic things. Has everyone got an employment agreement? Is it up to date with the new laws?
Yes.
Have you got KPIs? Have you got performance measurements so that you get measured and, performance reviews done at least 6 monthly? Have you got some kind of incentive plan that matches those KPIs? So it's all that basic people management criteria that need to be in place. Then we start to get into the smart things around, okay, what assets have the business got? Now, most businesses have got, plant and equipment and stock and a few of the other things, but they've also got intangible assets. So intellectual property, knowledge, the secret sauce, the things that make you particularly successful in your particular industry. Now, most businesses have got that, but the reality is most of them, it's not documented. There's no clear title. They've written a piece of software code. They don't even know where the code is anymore. They just use it and hope that it's going to be okay. Well, from a buyer's point of view, that's high risk. And whatever's high risk lowers the valuation. So in terms of your assets, you need to have all that documented. And that's, ownership of all the assets, not just the ones you can walk into a warehouse and see, but the ones that are up here in somebody's head, or the system or the process, or as I said, the secret sauce that makes your business more valuable. All that needs to be documented properly. And then lastly, we need to start to think about, where does our work come from? We're getting asked now, I got asked just recently for 4 years Google Analytics history for a client. So the buyer actually wants to see. Yeah. Now, that was never asked for 15, 20 years ago. No one even knew what that was. Now, everybody's looking at it because what they want to make sure is that if they buy this business today, is it going to have ongoing sales, or do all the sales come from my network and my referrals and my golf club or yachting club or, whatever it is that I'm into?
Yeah.
That's the type of sales organization you've got. That's a problem for a buyer. So your sales and marketing engine needs to be literally an engine. It needs to be automated and systemized, and it needs to have structure and ongoing. We need to know that there's going to be ongoing sales coming into that business. So from a buyer's point of view, they're sort of the key things. Now, as I said before, we're talking about them from an exit point of view, but all of those are just good business sense anyway. You should have all of that in place, whether you're thinking about exiting or not.
Love it. And look, just to finish on a final one, it's actually, what's interesting is that process you just described is actually very similar to raising money from an institutional or a corporate investor into a business. So I'm very familiar with that. So the final part I just recommend that companies do is that what's a simple thing is that typically when you go through this process of having discussions with potential buyers, they will have a lot of the same questions. Right. And it can become frustrating if you're still operating the business, still involved, answering those same questions over and over again. So what I recommend for any company looking to go down a capital raising or a sort of an exit process is to have those frequently asked questions lined up and ready to go, because effectively what you want to demonstrate is that efficiency. You want the potential incoming investor to be able to get as many answers as possible without you in the room.
Absolutely. And I think the big thing, and that's really good advice, but I think the big thing is entrepreneurs by nature are very positive, optimistic, and they're always looking at and therefore talking about, when they answer questions, they always go to growth and success and talk about what we could do this and we could do that and we could expand that. What they miss is most buyers are worried about risk, not about growth. Yeah. They're looking at the business saying, okay, that's great, fine, whatever. This could go wrong. How is that managed? What happens if this happens? How do you document that? So you need to think about it from a buyer's point of view. Same as when you go and buy a property. You know, go and buy a house, you always get a pest report done. You always get someone to check that the boundary is actually in the right place and all those sort of inspections, you know, property inspection, and make sure the roof doesn't leak. That's just looking for risks. And business buyers do exactly the same thing, but it's far more complicated because there's far more areas to look at, far more issues that could go wrong.
That is absolutely for sure. Well, Craig, that has been brilliant. Any final things you want to mention before we finish? How can people find out sort of more about what you do? And do you host sort of workshops for founders or sort of for owners and so forth? Like, how can people get more information for what you do?
Yeah, look, there's a stack of information, including ebooks and white papers and all that sort of stuff on our website, which is just successionplus.com.au. And there's regular events. We're doing 2 or 3 events a month at the moment, all online, so it's easy to access. And there's events on, you know, selling your business, how to value your business, employee share plans, some of the things we've spoken about today around how to prepare. And my last tip, my number one tip would be start as early as possible. Don't leave it.
Agreed. Well, Craig, thank you very much for your time. We'll put the links in the description box, and look forward to having further chats with you.
Good to talk to you again. Thanks.
Thanks, Craig.